protect your winning trades and stay in them to ride the big moves. Imagine yourself in this situation. You bought a stock for short-term trading based on your analysis, which was bang on. No sooner did you buy that stock, you saw the profits immediately starting to accumulate. Now here's the million-dollar question. Should you exit from the trade and happily take all the profits? Or should you stay in the trade and enjoy further profits? What if you hold on for more profits and the stock reverses? These questions tend to trouble the mind of a trader, and ultimately he decides to exit from the position only to see the stock skyrocketing after his exit. One of the most common regrets of a trader exiting from a trade is to find that the same stock has gone up substantially in the next few days or weeks. Perhaps this feeling is even worse than that of incurring a loss in a trade. Such is the volatile nature of the markets. Sometimes one can't quite control the impulse of booking out from a profitable trade early, for no trader likes the feeling of a profitable trade turning into a loss-making one. Without a set of rules, managing a trade is tricky. If one gets swayed by emotions, he or she is bound to make wrong decisions. Such instances are kept in check by a set of rules. Here, we discuss a technique which will help you to be on the right side of the trade for a major part of the market move. Of course, this is not a complete solution to your problem, but is way better than taking impulsive decisions. How can one strike a balance between maximizing profits while reducing the probability of a loss? This is where a trailing stop loss comes in. So what is a trailing stop loss? A trailing stop loss raises or lowers your stop loss level as the security moves in your intended direction. There are various methods for trailing your stop losses, some of which are manual and others can be automated. In this video, we are going to understand a very effective way of trailing your stop loss using the 8-period exponential moving average, EMA. The 8 EMA can be used on daily charts, weekly charts and monthly charts depending on the time frame used to execute the trade. The time frames are relative to your purpose. The longer the holding period, the larger will be the time frame of the chart. A short-term trader may use a daily time frame chart for trailing, whereas a long-term investor may use a monthly chart for trailing. However, the technique remains the same. Let's understand the process with the help of an example. Here we are assuming that a trader A has bought this stock, Loris Labs, for short-term trading using daily charts on 1st July 2020 at 525 rupees. Within a span of just 15 days, on 15th July, the stock has gone up and is now trading at 624 rupees. Trader A has garnered good profits of close to 20%. However, he is now confused as his gut instinct tells him to hold the position for bigger profits, whereas his head tells him to exit at current profit. He comes to us for advice and we recommend that he put into use a simple trailing stop loss technique. Let's understand this technique in detail. Here we have put an 8 EMA on the daily time frame chart. The tool is readily available on most charting platforms. You can clearly see that the price is nicely hugging the 8 EMA on its way up. This normally happens in a strongly trending market. In this trailing stop loss technique, the trader is to use the 8 EMA as his support level. The golden rule is, as long as the high of the candle stays above the 8 EMA, the trader can continue holding his or her position. The moment the high of the candle slips below the 8 EMA on a closing basis, the trader has to exit the position. Now let's get back to the Loris Labs stock price. As can be seen, the price has moved up from 620 rupees to 1040 rupees. But the trader continues to hold the position as throughout this up move, the high of each daily candle managed to remain above 8 EMA on a closing basis. Had the trader given in to his impulse and booked profits, he would have potentially lost a significant move in the stock, as the stock price more than doubled in the following weeks. By following the simple 8 EMA principle, we have ensured that the trader still remains in the position. At the current price, his total profit would stand at a whopping 100% from his cost price. That is the power of implementing a trailing stop loss. You will often observe prices respecting the ATMA in strong uptrends like these. Let's take another example to see where the trader actually gets an exit using this technique. This is the daily time frame chart of Aarti Drugs. Here, the trader bought the stock at 515 rupees in April 2020, and as of May 2020, the stock is at 715 rupees. The stock has garnered a profit of approximately 40%. This is a fantastic return on investment considering the time period needed for achieving this return was merely a month. The trader is now super excited and asks us whether he should exit. Since the stock was continuously making new highs, we again suggested him to follow our simple golden rule. As long as the high of the candle stays above the ATMA on a closing basis, the trader can continue holding his position. The moment the high of the candle slips below ATMA on a closing basis, the trader has to exit the position. Let's see the result achieved after following this principle. As you can see from the chart, the stock has really picked up steam post May 2020 and has started moving up sharply, hugging the 8 EMA. Notice the fake outs marked by the arrow? This fake out is nothing but the price moving below the ATMA on an intraday basis but closing back above the ATMA. By waiting for the high to go below the ATMA, we protect ourselves to an extent from these fake outs. Notice that after the first fake out at 800 rupees and the second fake out at 975 rupees, the stock goes all the way up to 3,400 rupees. The final exit is at 2,800 rupees, where the high of the candle is below the ATMA on a closing basis. This is another example where by using a trailing stop loss, the trader has managed to eke out the maximum possible gains, in this case a whopping 300%, from a stock by avoiding an impulsive decision. This technique can be used in exactly the reverse manner for short trades, where the trader will wait for the low of the candle to be above the ATMA on a closing basis for exiting from the short trades. However, there are a few points worth noting before you jump into using this beautiful technique. Too much greed can be dangerous. Don't expect this technique to give you an exact exit at the high of the move when you are in a buy position or low of the move when you are in a sell position. The idea is to capture a major part of the move. Don't use this technique on intraday time frames. Although it may still work, this technique will not be as effective on lower time frames like 5 minutes, 15 minutes and 30 minutes, since the lower the time frame, the more the noise. This technique is ideally suited for daily, weekly and monthly charts. This is strictly a trailing stop loss technique. Thus, don't use this technique to take fresh trading positions in a stock. A move above ATMA is not a buy signal. A move below ATMA is not a shorting signal.